Great, welcome. We're now going to do our standard on a page for IAS 17 on leases. Now this is going to be very high level, just introducing some of the most important concepts just to get you going. So I like doing this. I like trying to put a standard on a page. Now IAS 17 is very in-depth, so the standard on a page doesn't deal with the initial and subsequent measurement issues. We'll get to those as we deal with finance versus operating leases, etc. The first thing I do need you to know is what is a lease. So let's look at the definition. And we always start with the definition when we're talking about leases so you can identify what you are dealing with. So a lease must be an agreement, right? So there's going to be two people. And in this agreement, the lessor will convey to the lessee in return for payment or series of payments the right to use an asset for an agreed period of time. So there must be an agreement, two parties, the lessor and the lessee, and then there must be a payment or series of payments from one party. The lessee is going to make those payments to the lessor. Then the lessor is going to give up the right of use of an asset to the lessee, and we must say for how long this right of use will be given up. So I've spoken a lot. You will be dealing with a lessee and a lessor. Then underneath the lessee and the lessor, you will come across a classification issue. All leases will either be finance leases or operating leases. Okay? Now a finance lease, quite straightforward. Finance lease is like a real economic sale of an asset. Okay? The lessor must transfer substantially all the risks and rewards of that asset to the lessee. An operating lease, well, that's just like straightforward rental, right? You go rent a car for 2 days, that's an operating lease. If you go and purchase a car, okay, but you're going to do a finance lease or a hire purchase agreement over 5 years, well, then you're paying it off and the car is actually yours. Then that will be a finance lease. Later on, we get to more complex things later on in your studies, such as sale and leaseback leases, okay, and that will be only on the lessee side. Okay, you'll have a sale and leaseback for a finance and an operating lease. That's basically where the lessor or the party owns the asset, needs to raise some money, goes to a bank, sells the asset to the bank and leases it back in order to raise money. Okay, on the lessor side, you have operating and finance lease again, but remember there is going to be a certain type of finance lease as a lessor where we deal with manufacturer or dealer lessors. Okay, that is like your car dealer. There they are not selling an item of PPE but inventory, right? And we're also going to discuss something around an installment sale agreement. Great, so not all the courses will cover all of this. The basic courses will probably deal with just lessees and finance and operating leases. As you get into more advanced, say third year or postgraduate kind of studies, you'll deal with sale and leasebacks as well as lessors, both normal and manufacturer dealer lessors. The question I want to ask next is, why does IAS 17 exist? Why did the Accounting Standards Board create this International Accounting Standard 17? Well, understand that in the real world, accountants and businesses have a lot of hidden motives, right? And leases, before they were governed by IAS 17, were often used to keep liabilities off the balance sheet. So we would buy or get use of assets, okay, but we wouldn't want to raise a liability for the funding because it messed with our ratios. So what we would do is we would rent the asset, right, and just have a monthly or annual expense but with no asset or liability. And that would boost assets return ratios, for instance. Okay, so IAS 17 was introduced to create, well, we need to disclose the economic substance over legal form. Okay, so I don't care if the contract says this is a lease agreement, a rental agreement. If, however, in reality, the risks and rewards of ownership for that leased asset have transferred, well, then the lessee must recognize an asset with a corresponding liability. The lessor must de-recognize the asset. Okay. Also, we needed consistency. Okay, we needed one company in the industry, airline company number A and airline company B, to treat their leased aeroplanes in the exact same way. So consistency, that goes back to the framework and IAS 1. And obviously this is trying to reduce financial manipulation as well. Great, so that's a little intro. You understand there's lessees, lessors, finance and operating leases. We are going to cover this in a lot more detail in the next few lectures. Great starting point. Thank you.